Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs, and this week's episode is all about covered call ETFs. And maybe more generally, higher yielding ETFs will be the topic of discussion. Not too long ago, we were at record low interest rates, if you can believe it. Investors were really scrambling to find cash flow in their portfolio. Fixed income wasn't paying much. And that is when BMO ETFs came out with our covered call ETFs, which we really launched to solve this issue for investors who were searching for yield. The popularity of these ETFs more recently, even with rates coming up, has really exploded. And there's a lot of new issuers entering the market, launching new ETFs. It seems like monthly now. And investors are really drawn to the yield on these ETFs. In some cases, we're seeing some newer investors, in that accumulation stage of their investment journey, buying these income-oriented solutions, not really who we had intended it for in the beginning, which was more around the retiree crowd, which is interesting. All this to say, we really feel there's a lot of due diligence that investors should be doing to fully understand these solutions. And today we're going to get into some of the questions that we've been receiving from you guys as the investors around this, which is really helping show us that there is more education needed on this topic. Before we get started today, we're not providing investment advice or recommendations. Today is all about educational purposes only. With me today, I have Chris Heeks, Portfolio Manager for our suite of covered call ETFs. So welcome back to the channel, Chris. Good to have you.
Thanks, Aaron. Always good to be here. Pleasure.
Yes, you've been on a lot lately. Our expert of the month. To get us started, Chris, and sort of set the stage, I mentioned the rise of covered call ETFs, exploding more recently, and how it's important for investors to do their due diligence. And not just get enchanted by those yields they're seeing posted on advertisements and websites. And I think we're not the only ones that feel this way. Regulators are starting to take note as well. So walk us through the announcement more recently that we saw from the OSC around sales communication and yields. I thought it was pretty telling.
Yeah, for sure. And, investor education is always key. So let's do some education today and to talk about some of the things that are happening in the market. Like you said, covered call ETFs have been great for generating income for clients. And, even more recently, when inflation was 6, 7, 8% a couple of years ago, and you're looking at what can keep up with inflation, well, fixed income yields were still low at that point. Equity yields weren't anywhere near that. Covered call was a natural strategy. So even in the last 2 years, kind of 2022, 2023 as we go into this year, saw a real boom into the market, new issuers, new strategies. And what we also saw was some envelope pushing yields, as you mentioned. And, I think anytime you see a yield higher than 10, you as an investor should ask yourself, am I going to get return as well as this yield, or am I just going to get yield and maybe some negative price appreciation? And obviously, as human beings, I think we respond well to numbers, and bigger is generally better. And 15% yield, let's just use as an example, that sounds attractive. But let's face it, equities generally return 8, maybe 10% per year on average historically. If you're going to do a 15% yield on top of equities, well, that means you're probably going to be paying out of your capital return. But what we've seen in the industry is, other providers have exceedingly high yields and selling really ETFs based on yield alone. And I think that's where the OSC stepped in, the regulator, and said, it's very important to look at more than just the yield. So the 15% yield is the sticker that attracts us. But what the OSC reminded the entire industry was, we shouldn't be selling products based on yield alone. And that yield is a performance measure. So anytime you look at yield, you should also be looking at, investors, what's the total return? And, it's nice to have the yield, but if your price is going way down, maybe that's not such a good thing. Maybe that's not. And so they just really, the regulator's there to protect investors. And, it's important to look under the hood. And sometimes if it is too good to be true, that might actually be the case. So I'm sure we'll get more into it. But the OSC just really wanted to focus on investor protection and make sure that, we understand the consequences of high yield, some of the things it can lead to, and make sure fund companies aren't kind of just advertising yield to get dollars in the door, because, at BMO, we would say that's the wrong approach. We want to invest, we want to educate the public and find the products that are going to work best for you.
Right. So they said no advertising yields if the fund is less than a year old. They said if you're showing just the yield, you have to show all that standard performance data as well, just so that the investor has that full transparency. So I think it's definitely a good thing for the investor. You mentioned total return. What should investors keep in mind when it comes to investing in these products, when it comes to total return specifically, sort of that balancing act between growth versus income?
Yeah, and that's a great way to put it. I think of a covered call strategy, at its heart, it's going to trade away some potential upside for current income. And, there's different kind of, call it, rungs along the ladder in terms of where you're at. But the basic trade-off is there. So the more income you generate, the less growth you generate, or the more growth you want, the less income. So, as an investor, you have to find where's that happy medium. But, the reality is we can't have both. We can't have super high income and super high growth. I wish we could. We would launch the fund and we'd all be that much happier for it collectively. But, you see that there's a trade-off there. Now, we could actually generate covered calls. We could do a 30% yield. There's some products in the US right now, Aaron, that are like 50% plus yield.
Yeah.
And we're not going to get into those. And I don't think I don't think it's a great way to go.
Not a sustainable strategy.
No, and you want to be built to last, and that's what we're all about, and being sustainable. The yields on our strategies are going to be about 6 to 8%. Again, if equities are returning on average 8% a year, that's sustainable. If you're distributing 15% or 20% yield, that's not sustainable. So, I think from an investor point of view is, okay, you see a product, it's got 15% yield. Okay, check a box, but then look at the price of the ETF and how is the price fared? Because a lot of times, like I was saying, to get to the 15%, you're going to have to over distribute to get there. Mm-hmm. And you very much see that with these products in the US that I was mentioning, right? And you'll have 50% yield, but guess what the price is doing? It's going straight down. So yeah, that's why I think it's important to look at total return, and you should be able to find that on any provider's website to see what's the total return. What am I getting, in addition to the yield, and am I getting what I want?
And over a longer term period too, right? Like BMO we've been doing this for 11, 12 years. So over a decade. So all through different market cycles. And you have that track record that you can look at to show that this is a sustainable yield that we're delivering to clients. So definitely look for that track record, that trusted provider, professionals like you. I can't speak today. Professionals like you managing the money. So that's great. Can you give us an example? I was thinking maybe using ZEB versus ZWB, using our ETFs of long only versus covered call, and what that looks like when it comes to performance.
Yeah, for sure. And maybe I'll get into that, but just before I do, because it just made me think, we've been doing covered calls since 2011. We have seen this before where providers would come in with really high yields, would attract client assets, but at the end of the day, what did it fail to deliver? Failed to deliver growth, and it also eroded NAV. So to be honest, this is kind of like a deja vu of 10 years ago, and we saw it, and we saw how investors were disappointed. So that's something to just keep in mind, and we'll see how that evolves. But going back to total return versus a covered call strategy, and how an equity performs versus covered call, I encourage people to have realistic expectations. Covered call is for income investors who are willing to forego some of that, upside in growth for more income and a little bit less volatility, a little more stable NAV, because the extra income does provide that as well. So Just looking at my notes here, wrote down some numbers. You got the ZEB, so that's our Canadian equal weight banks, just regular old six banks, reweighted equally twice a year. And then the ZWB is obviously the covered call version. So the yield is ZEB right now is 4.7%, pretty attractive on Canadian banks. The covered call yield is 7.4. So again, in that range where we think it's robust. So we have a common inception going back to January 2011. If you look at the annualized return, if you were just trying to maximize return, where would you want to be? You would want to be in the regular equity strategy. So ZEB returned on average 9.8% annualized total return over the past. Now it's about 13 years now. ZWB returned 7.8, so 7.8 per year. Now, what did it give for investors? Gives you a lot more income on a monthly basis. It's also, like I said, lowered the volatility a little bit compared to equities. But again, more tailored for an income investor than a growth investor. So there's certainly advantages to getting yield, pay monthly bills, or whatever you need that monthly yield for. But again, if a total return investor who can take on the equity risk, typically better to go in that traditional equity approach. And then I'll just add on to that. That's over a long period of time as equities go up, and they generally do. Another use we see on the covered call side is if you think markets are going sideways, they can add value. So, a couple other numbers I wrote down here. 2018 wasn't the greatest year for Canadian banks. ZEB was down 9%, but the covered call added 1% of value. So it was only down 8%. So it added some value there. So something to keep in mind. Now, I want to make one more point. I'm sorry if I'm answering this a little too long.
No, it's good.
The one other point is the details and how you do it. And I think we'll talk about this a little bit more as we go through. But, as we said, over the long period of time, ZWB gave about 80% of the return of the ZEB. Returned 7.8 per year versus 9.8. Now, that's not going to be your experience across the board. And the other thing that's, going to matter is how the provider does it. Are they using leverage? Are they doing options that are closer to the money, that are more aggressive? And if they have those high yields, the options might be more aggressive. So remember that trade-off, income and growth. If there's more income, there's less growth.
Right.
So, what you might find over the long term, and what I would expect to find versus a product that has that higher yield, is less growth. So keeping in mind that kind of rule of thumb, it's not just a one size fits all across the industry. It really depends on how you're doing it. And, at BMO, we're trying to supplement that income by an extra, call it 3 to 4% on top of the equity, trying to have a light touch. But again, that might not be the experience you have everywhere else.
Right. And I think that ZEB versus ZWB is a great example, but it's not always going to be that clean to compare the two, right? That just happens to be that we have the long and the covered call, but it gets more complicated as the underlying holdings, get away from the index and that type of thing to compare the two strategies. So keep that in mind. You kind of jumped ahead to my next question, Chris, but I wanted to get into that option strategy and, drive home the importance of understanding how the calls are being written, which comes with a transparent provider. But explain to us the difference in a bit more detail in terms of at the money versus out of the money and what that outcome would really look like for the investor at the end of the day.
Yep, for sure. So, there's a couple big dials that a covered call provider can do to provide income. The one is on what percentage of the portfolio are you going to do calls? In our case, we do it on half the portfolio. You might, on some of those higher yielding options, you might find they'll do it in more than half. But obviously, if you're doing it on half and equities rally, half your portfolio is going to gain full participation. The other half, you might have partial participation because of the call. So that's one. But number two, and I think this is actually the more important, is the at the money versus the out of the money. This is actually more what we see under the hood is driving some of these differences. We're going to use out of the money options. We're going to sell them as far out of the money as we can to get our target yield. So we want 3 to 4% extra. If the market's really rich in volatility and we can sell that option 5-10% out of the money, then we're going to do that. And what that helps for investors is that the further it is out of the money, that means as stocks rally, you capture more upside return. But what we do see is, in order to achieve some of those higher yields on the market, providers going more at the money options. So now, say you're an at the money option. That means as soon as the stock goes up at all, you're already losing money. So stocks do generally go up over time. So the expectation is you're going to lose more money on the options and give up more on the growth side. So those are two dynamics: the coverage and are you using at the money or out of the money options. And as a client, you can decide where you want to be. But I think that's the one thing you'll probably find with the higher yielders is you're being much more aggressive with that option approach that they're using.
Yeah, which will impact the level of growth. Okay. How important is that sort of underlying portfolio construction side of things? We talk a lot about yield. Investors obviously are really interested in how much yield those options are generating, but what about that underlying portfolio? How important is that?
So very important. And that, I'm sure that's why we're talking about it. It's very important. So, with covered calls, there is a tendency to talk about the options because it's fun, it's innovative, and it's what drives that additional income. It's what takes it from 1.0 to the 2.0 in terms of income generation. The 1.0 being just simply holding the equities and collecting a dividend yield. But I would say always look at what your underlying construction is, because your number one driver of return will be that basket of equities that you're investing in. We saw Canadian banks; they've got a pretty good track record, 10% a year for about 13 years return. That compounds over time in a pretty nice way. Obviously, when we're rolling out a strategy, we want to make sure it's as robust as we can possibly make it. And we've got, several that are linked to high dividend, blue chip dividend payers, not just high dividend payers, but blue chip dividend growers, sustainable dividend payers that can accumulate over time. Certain sectors like Canadian banks or technology, where we think, it makes sense to consider a long-term allocation. But never take it for granted, and it's certainly, that's a primary, you should probably be asking that question number one.
Yeah.
If you're considering a covered call product, first consider, do you want to actually own the underlying exposure? Because that is key.
Let's talk a little bit about leverage, because many of the covered calls now available, not with BMO, but some of the other ones on the market right now use a little bit of leverage, giving them, that higher yield. What should investors be considering when it comes to leverage on a strategy like this?
Okay, so here's where there's three things, and I'll just get right into it. And so lightly levered is what we call it. It sounds very innocent. It's just lightly levered. So 25% leverage. So here's what happens. So you have an 8% yielding covered call. You lightly levered it with 25%. Now you get that extra 2. Now you call it a 10% yield covered call. This is what the industry's doing. Here's one thing that's pretty wrong about that is cost of leverage is 6% right now. Like the overnight rate is about 5%. So if you're going to borrow cash to lever up your portfolio, it's at least going to be somewhere around 6%. So you are not borrowing risk-free to add 2. You're paying 6 to get 8. So first of all, what they do, the calculation of just simply inflating the yield number by 25% is pretty disingenuous, I would say, and not really being fully disclosing the costs that are involved with that leverage. You will see, and I think we're going to talk about costs, but you will see that cost come through on the MER, but sometimes that's kind of a little hidden from sight. So that's one thing that I don't agree with. But the other thing is, think about a covered call strategy, and I think leverage is, I'm agnostic to it. It's live by the sword, die by the sword. Leverage will magnify losses and leverage will magnify gains, right? So I'm not here to speak out against leverage, but consider it in the covered call framework. So on the downside, a covered call is similar to an equity. You're going to pick up a little bit of extra income every month, but it's more or less similar to an equity. So you're going to magnify the losses on the downside. But then on the upside, every covered call, and some of these high yielding ones, you are tapping out some of your growth. So if you lever up on the upside and you're already, let's just say you're fully capped, and you lever it up, well, you're still capped. The leverage doesn't add some kind of magical extra upside. Mm-hmm. So to me, you're magnifying the downside, but you're not necessarily magnifying the upside as much as you you really ought to be for taking on that extra risk that comes with leverage even a little bit. So, so I think consider whether it makes sense in the covered calls. I think you can tell from my opinion. I don't think it makes a lot of sense on the covered call side. And then just simply, using it as a means to go from a yield of 8 to 10. But if you're not disclosing the cost of leverage, I think that's another issue to consider.
Yeah, I think that whole transparency around fees is a really important topic. We started to see a lot of advertisements out there, 0% fees. And what that really is it's only talking about the management fee. So where can an investor go to find that full picture, which would include things like the cost of leverage, if it applies, the cost of underlying ETFs, if it's a fund of fund, like where can they go to find all those other layers?
Yeah, 0% management fees. We should know right off the bat something's a little bit wrong with that. I mean, where's our $0 grocery store where we just walk in and take what we want? It's never zero, and usually what it is, like you said, it's on the fund of funds or ETFs. So an ETF that holds other ETFs. They'll say, hey, this ETF's free. But by the way, what I'm not telling you on the website is all the other ones, or perhaps you're not. Maybe it's there, maybe it's in fine print. Who knows? Probably not in that big 0% print they're using. But, the ones, we're going to charge you on the ETFs that are held underneath. Oh, and if we're using leverage, we're going to charge for the leverage, and we're not going to, obviously disclose that. We'll just say it's 0% management fee. So falls under that framework of technically true, but not really showing the whole picture. So to answer your question, the best place, and I use it myself, just as as an ETF portfolio manager researching different ETFs, is to go to the website and look for the ETF facts document. It's called ETF facts. At the BMO website, it's on. You type in the ticker, you go to the page. It's on every single one, and you can simply load that up. It's required to be on every provider's website, so you should be able to find it no matter where you look.
Yeah.
It's going to show you everything. Shows you the management fee. It's going to show you the extra management fees that might be being paid on sub funds. It's going to show you any expenses associated with trading. And it's going to show you the expenses associated with leverage, if any. So it's kind of like your total cost of ownership. So and I will say we've seen swings from what's on a website, from a management fee to your end number perspective, swings of nearly 2%, if not more. So look for that ETF facts document because, I think, listen, like covered calls, and if your end fees are over 2%, it's like, Houston, we got a bit of a problem. And if you're saying it's zero, I think we got an even bigger problem.
Yeah. Very good. Well, that's a good spot to end because that fee transparency point is a big one that we wanted to drive home. But with more of these products coming to market, it's obvious that a quick glance at that distribution yield is not a sufficient due diligence process anymore. So being equipped with the right information, partnering with a trusted provider who has a track record, who provides a level of transparency, a high level of transparency, is ultimately going to get you into an ETF that's going to help you reach your investment objectives. So you can check out bmoetfs.com for our covered call ETFs. You can also check out etfmarketinsights.com, our website that has a ton of additional resources on covered call ETFs. Next week, we will be taking a break. It's March break here in Ontario, but we will be back on March 22nd with an episode on changing demographics in Canada and things that investors should consider when it comes to things like longevity risk, just as one example. So we've got some really interesting research to share with you, and we'll see you then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.